Hello and welcome to Move or Improve with Debbie. I'm Debbie Miller, your host, and thank you for joining me. You know, you've seen those commercials on TV about selling your life insurance policy, and I've been curious about what that really means. So I am fortunate today to have a life settlements expert and longtime insurance consultant, Matthew Friedson, and he is going to offer his perspective and his opinion and a little behind the scenes stuff of what really goes on when you sell these types of policies, because he specializes in complex insurance applications of estate and business planning, and he educates his clients and helps them develop and implement creative strategies to meet their objectives. And he must be doing something right because he's been voted by industry peers as one of the best insurance consultants in Washingtonian Magazine. And I know for having read that magazine, you have to be good to get in there. So welcome to the show, Matt, and let's get started with these questions.
Well, thank you so much, Debbie, for having me on. I think first and foremost, we'll talk a little bit about what a life settlement is. A life settlement is when a policy owner sells a life insurance policy to a licensed secondary market fund for more than the carrier's stated cash surrender value of the policy. There's billions.
How did the concept get started, though? I mean, people need to know the background on that.
Yeah, so interestingly, it was decided by a Supreme Court case all the way back in 1911 called Grigsby versus Russell. And in that Supreme Court case, it was determined that life insurance is real property, just like a home or any other asset that you might have, and you should be able to sell it to any willing buyer at the market value. There was a big spike in the life settlement industry that began in the 1990s during the AIDS crisis, when people needed large sums of money to afford uncovered medications and end-of-life care. What happened in the 1990s is not like the modern life settlement industry today. Today, there's significantly more regulations and offers options to clients who have a relatively long duration of life to live and simply want alternatives to cashing their policy in for less than the market value.
So are there any laws governing the sale of policies so that fraudulent behavior isn't rampant? What's involved with that? How does that work?
Yeah, that's a really good question. And that goes to some of the additional regulations that have come up over the years as this has become a more formalized space and industry. There's several safety measures for the consumer, but there's still some aspects that we should discuss that are underregulated. I won't say unregulated, but certainly underregulated. First and foremost, any buyer or funder needs to be licensed in the state that they want to purchase a policy in. It's no longer someone down the street from you, a friend or a neighbor or a doctor. These are large institutional funds, typically $100 million to multi-billion dollar funds. Think private equity, endowments, hedge funds who are purchasing hundreds and thousands of policies in their portfolio. The major item that I mentioned when it comes to underregulation is the compensation and fees within the transaction. That's a little bit opaque still. States have statutory maximums that brokers can charge, but they're not always transparent. We pride ourselves on being transparent with our compensation model up front. And because of how we're structuring our firm with direct relationships to the licensed funders, our fees are around 50% less than the industry average. This is one of the major reasons clients work with our firm and firms like ours, since the outcome nets the client significantly more money in their pocket.
Well, Matt, how can your company do it for 50% less? Are they other companies just making more in the profit margins, or what's going on with that?
Yeah, so the easiest way to explain that is comparing the analogy of a real estate transaction. Speaking your world language a little bit. Typically in a real estate transaction, the buyer has a representative and the seller has an agent as well, and both sides get compensated in the transaction. What we've been able to do is cut out the buyer's representative due to our expertise and relationships that we've built in the market, so that we cut out the buyer's agent and we go directly to the buyers themselves.
Interesting. Okay. Well, that makes sense. There would be 50% less. But why would somebody want to sell their policy? I mean, you get term insurance for protecting your children and your family while you're younger, and then you get older. But why would they sell a policy that's still in effect and move on?
Yeah, so everybody's situation's a little bit different and unique. So I'd like to say we've seen it all, but I'd like to hit on a couple of the major reasons that we see in the market of why people are selling policies and why it may make sense for them. And then later we can talk about a few examples as well. The most common reason why people sell their policies is that their situation's changed. They needed insurance at one time, and now they no longer need it, whether they're in their 70s or 80s, or sometimes even 90s. They either don't need the coverage or they can't afford the premiums anymore, or perhaps are focused more on their own retirement cash flow and their own long-term care and longevity planning, more so than they are with leaving an inheritance for their children, whether that's because their financial situation has changed or because maybe their children have become successful as they've become independent and they're more concerned with themselves now and living in dignity at the end of their life than they are with passing assets down to their children. I should also mention that there's a real issue happening in the insurance marketplace, and some of that's due to the interest rate environment. Old universal life policies, typically from the 1980s to early 2000s, have underperformed dramatically. So most people who hold these policies have been paying premiums for 10, 20, 30, sometimes even 40 years, and don't know that there's an issue within the policy that might affect the death benefit being there when they pass. So a lot of what we do is policy reviews on those policies to look at the future projections and what clients would need to pay in additional premium to prolong the death benefit outside to beyond life expectancy. And sometimes the clients can't afford it or aren't interested in paying the additional funds, so they decide to sell the policy to recoup some of the money that they paid in lieu of getting little to none. And the last thing that you mentioned was a term insurance policy. It's very popular these days and fairly new in the market to sell or settle term insurance policies. Term insurance, typically you buy it to bridge a gap of financial security. You buy it when you need to make sure your liabilities are protected, your children are protected, perhaps to maybe sell a business or become more liquid, sell a property in retirement, and downsize. And once the term ends, you don't need it anymore. Well, we've had a lot of success settling term insurance policies that seniors no longer need and are towards the end of the term. The caveat is that they need to still be convertible, which is a contractual provision that I'll discuss later as well.
Yeah, that's something I think, does it depend on your age and your health as to if you could sell your policy, or is it something else? And that's something that we need to talk about. But first of all, let's find out, what are the age requirements and how does somebody qualify? I mean, like I said, is it their age? Is it their health? What makes it usable?
Yeah, so it's a confluence of factors. The primary factors being the age and health, as well as the economics of the policy or the contract. So the heart of the market is age 70 and older, and policies 500,000 and above, but there's always exceptions to that. We've settled policies for under 500,000, and we've settled policies for people who are under 70. Now, 70 is kind of the magic number because if you're younger than 70, your health problems need to be significant. As you get older than 70 and out into your 80s and 90s, you don't necessarily need to have any health problems at all to qualify for a settlement. At that point, it's really the economics of the policy. So it's three factors: age, potentially health, depending on your age when you're looking to settle a policy, and then how good the contract looks from an economic perspective.
Interesting. This is really opening up a whole new world of information that I think people need. What do you need for a life settlement? In other words, what's the process? We call you or whatever, another company, heaven forbid. But anyway, if we call Matt, like we should, what would you ask for and how would you start the process?
Yeah, to complete an analysis to determine if a life settlement's even possible, we have a 2-page questionnaire, and we would need what's called an in-force illustration. That's a projection of what the policy looks like moving forward, and that can be provided by the carrier. There are some limited funds that we work with who will provide formal offers with just this information. Most of the other funds in the market want to do full underwriting to have a better understanding of the insured's health, and they would review medical records as well.
Interesting. Okay. Well, so how long does it take? Who does the selling and how does that process work? And how long does it take to get a response as to whether you can sell it and you qualify?
Yeah. So that can differ quite a bit. I mentioned that there are funds who will do it with no medical underwriting. That can be fairly quick. And we're working on one now where the client had a premium due in a month and they didn't want to pay that upcoming premium as it was going up substantially. And we were able to get them an offer and get the contract completed within a month's time. Now, typically, more typically, I should say, budgeting 2 to 3 months is appropriate for this type of transaction. So it's better to get on it ahead of time if you can and not leave it down to the last minute. I will also say that one of the important things, you said who does the selling. There are quite a few people who market life settlements, and there's different arrangements that they have from a compensation perspective, as well as a structuring perspective. People like me, as I mentioned, are sellers representatives. We represent you, the client, and shop the policy to all of the state licensed buyers in the given state that the contract is cited, and we hold an auction process. So we have all the bidders kind of auctioning off. Typically takes a few weeks to go back and forth, and that allows us to get what I consider the fair market value for the policy, to have all of the buyers available bidding on the policy to see who will pay the most. There are also, you've probably seen direct to client or direct to consumer advertisements like on television. And Debbie mentioned the television commercials. I think it's important to tell consumers a little bit how that works. Since these funds are going direct to clients, they're in no competition with other funds to make the offer, which doesn't always get the highest offer to the client, but more likely the least they can pay to get the client or consumer to sell their policy. So I have a good example of that to share with you. We received a call from a client of ours that they had called the 1-800 number on the TV. When they were watching late at night, they saw they could sell their policy. Their premium was coming up, and said they were thinking, maybe I don't need this anymore and I can get out of the way of this premium in retirement. They had $1 million